Sometimes the easiest way to understand a retirement income plan is to do so visually. And if you're on YouTube and you're watching videos about certain topics, then most likely you're a visual learner. The easiest way that I have found to lay out a retirement income plan, at least from a visual standpoint, is by using a bucket strategy. And in this video, we're going to get into what a bucket strategy is and the method that I have found to be the easiest, the two bucket strategy. Stay tuned. Welcome back to Financial Wellness Planning. My name is Derek Coffey and I'm the founder of FWP. And last Friday, we put out a video on sequence of return risk and how it is the biggest risk that you may face in retirement. And if you haven't watched the video or you've never heard of the term sequence of return risk, the premise of that risk is that you retire and immediately retire into a down market or experience losses within your investment accounts. And the reason this risk is so large is because if you retire and experience 2 or 3 years of losses, it could throw off your entire income plan. Now, we went over ways that you could go about buffering yourself against sequence of return risk, and using the bucket strategy, you can do that. So not only is the bucket strategy good for visualizing your retirement income plan, it is also a way to help protect yourself from the threat of sequence of return risk. Now, I want you to keep in mind, there are a bunch of ways you can operate a bucket strategy. You could use 2 buckets, 3 buckets, you could add a 4th bucket. But the most simple way to use a bucket strategy is to just have 2 buckets. Bucket 1 is what's going to be 1 year of your income need, and we're going to go over how that's calculated later in this video. And then bucket 2 is your invested money, the money that's meant to grow and ultimately refill bucket 1. Now, before we get into the bucket strategy and how it all operates, I want you to keep in mind that this video is meant for educational and informational purposes only. Before you make any investment-related decision, make sure you sit down with a licensed professional before you implement them into your plan. When it comes to using the 2 bucket strategy, the whole point is to segment your invested account money into 2 buckets. Now, you can segment the money however you want using whatever percentages you want, but the way that I would suggest doing it is that bucket 1 contain 1 year of your income needs. And that money is meant to be in cash or CDs, something that's very safe and not subject to what the stock market is doing. And the purpose of that 1 year of income needs is to act as a cash cushion. And if you watched our video on sequence of return risk, that's one of the ways we talk about keeping sequence of return risk at bay. If you have a year of your income needs sitting in cash and not subject to what the market is doing, then if you retire and immediately retire into a down market, then you can pull your income from that cash. And the whole purpose of this is to help keep you from selling your assets at a potential loss. So with the 2 bucket strategy, bucket 1 holds that 1 year of income or your cash cushion. Now, to figure out how much money you need to have in that bucket, we have to do some math. If you're married and each of you are due $2,000 per month from Social Security, you're going to have a grand total of $4,000 per month coming in guaranteed. Now, if you work through your numbers and you're building out what your retirement income plan is going to look like, and you determine that you need $5,000 per month to live, then you have a $1,000 per month shortfall. So if you're down $1,000 a month and we want to fill bucket 1 with 1 year of income, we're going to multiply that by 12. That's going to give us $12,000 that needs to be in bucket 1. Again, and it's going to be sitting in cash. Now, if we're using the 4% rule, ideally, this $12,000 is 4% of your invested account balance. So if we divide the $12,000 by 4%, that's going to give us an account balance of $300,000. Again, this is total. So of the $300,000, we're going to take $12,000 of that, put it in bucket 1. The other $288,000, we're going to move over to bucket 2. So in bucket 2, we put in the $288,000. What is that money meant to do? Well, it's meant to grow. That's the purpose of bucket 2. That is where your investments lie. So with the $288,000, you're going to put it into whatever asset allocation fits your risk tolerance. If you can't handle a whole lot of risk, then you need to be conservative with those investments. If you can handle a little bit more risk, then maybe you can be a little riskier with those investments. But the whole purpose of bucket 2 is to ultimately refill bucket number 1. So periodically, you're going to rebalance these buckets, and the growth that you experience ideally from bucket 2, you're going to sell some of those assets to refill bucket 1. So for the purposes of this video, we're going to assume that bucket 2 is invested in a 60-40 portfolio, where 60% of your money is in stocks, 40% of your money is in bonds. It's not flashy, it's not overcomplicated, it's simple, just like the 2-bucket strategy. The whole point of this is to keep your retirement income plan simple. So how does the 2-bucket strategy with 4% in cash and the rest of it in a 60-40 portfolio actually operate? Well, I'm going to show you. So what you're looking at on your screen is the results of this strategy since January of 1987. Of the overall portfolio, so the whole $300,000, we have 4% that's sitting in cash. And this program doesn't give a cash option, so we are using the 3-month T-bill, but it's close enough. We have 38% of the portfolio in the Vanguard Total Bond Market Index, and then we have 58% of the portfolio in the Vanguard 500 Index. Again, 4% in cash, the remainder in a 60-40 portfolio. This is how the percentages break down. What we're also taking into account is a quarterly rebalance. What this means is that every quarter, assets get sold to replenish bucket number 1. And the reason that I do it on a quarterly basis is it just makes sense mathematically. If you're taking out 4% for the year, you're taking out 1% every quarter. If the markets are doing okay or they're doing really well, then you rebalance on a quarterly basis. Now, if the markets aren't doing very well and they're doing poorly, then maybe you want to stretch out how often you rebalance your accounts. But that's going to be on a year-by-year basis. Since we're just looking at an example, we're going to go with quarterly. But what you'll notice is that the annualized return since January of 1987 for this setup is 4.4%. But you have to keep in mind, we're taking out 4% every single year as income. So you're able to take out the 4%, you're also able to realize an additional 4.4% of growth, which is more than inflation, so it keeps the 4% rule afloat. So if we take this all the way back to 1987, we begin retirement with $300,000. 4% of that is sitting in cash for our income needs. The other 96% is invested into a 60-40 portfolio. This graph will show you what actually happened over the course of those 37 years. So we started with 300,000 and the accounts grew. All the while, we're taking out 4% as income. And then at the end of May of 2024, this individual would have just shy of $1.5 million still in their invested accounts. So this strategy does work, and it doesn't have to be overcomplicated. Now, keep in mind, we're looking at historical data. We don't know how this is going to perform into the future. It's done well so far, but with interest rates being the way that they are, we don't know what bonds are going to do. We also don't know what stocks are going to do. So the 8.4% that we have seen historically come from this setup, it may not hold, but there is enough wiggle room to where even if it drops to 7%, then the 4% rule still is in play. But the whole purpose of the bucket strategy is to help you visualize what your invested assets are doing and where your income is going to come from. Knowing that you have that 4% or the 1 year of your income needs sitting aside in cash and safe is going to help you rest a little bit easier in your retirement. There are going to be people that say, well, 4% is a really large allocation to cash, and they are exactly right. It is going to diminish returns. If you only had 2% of your money in cash and then 98% of your money invested in a 60-40 mix, then your returns are going to be greater. But there is something to be said about the stress levels of the retiree. Throughout their working career, they've been receiving their checks from the company they work for. Now they're relying upon their invested assets to produce that income. So understanding that 1 year of their income needs is safe is going to help keep them from making any knee-jerk reactions to whatever the market is doing. So having your money laid out and bucketed into 1, 2, or 3 different buckets is how you can kind of keep tabs on how your retirement income plan is going. Now, you can make it as complicated as you want. You can make it as simple as you want. I prefer simple. The 2-bucket strategy is simple. It's easy to use, it's easy to maintain, and it's easy to understand. The more buckets you add to it, the more you complicate it. So don't overcomplicate your retirement income plan. It's simply all about the numbers. You take the money that you have guaranteed, so your Social Security and a pension. If you're eligible for a pension, you have to factor that in too. But you take your Social Security, you subtract from it the amount of money it's going to cost you to live in retirement. We did that in that example. Whatever's left over, you multiply that by 12. That's what goes into bucket one. The rest of your money is what goes into bucket two. You put it in a 60/40 portfolio, and these are the results you may experience. Your retirement income plan can be this simple. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone that's in the process of building a retirement income plan and they just can't wrap their head around where their money's going to come from, then send this video to them. Maybe it'll help them understand a little bit better. But I want to thank you so much for tuning in. I'll talk to you soon.